type of loan are we going to dive into today?
I think we can focus on agency right now. Agency is probably the most similar to residential loans. I mean, the reason why is, as you can see, these are backed by Fannie and Freddie, which are the same agencies that do residential. So Fannie, Freddie, two different mortgage-backed security agencies. They do a lot of resi and they do commercial. So this is their commercial product. So the process is somewhat similar. You need to work through an intermediary. There are several intermediary banks. I think there are probably 20 or 30 approved intermediaries in the US that sell to agency. They self-fund and they sell to agency. Some of those are, there's Greystone, there's Walker Dunlop, there's, a number of different ones. Also, a lot of banks, a lot of the approved intermediary. So the way that works is we go to an intermediary, right? We go to our guys who run the agency at Chase Bank. Everything works through them. You don't work through agency. They're in the background. And basically, what are they looking for? Agency only does residential properties. They'll do any residential property, basically loan size over $1 million. So you're talking about like a 1-2 purchase price. Or value.
Multifamily only.
Only multifamily, right? And you see that down here, only multifamily, but they are a good option for multifamily. The reason why they're good is their pricing is generally very competitive, right? Take a look here. This is Treasury plus 180 to 300, depending on the size of the deal and kind of the risk factors, location, right? So today, if Treasury is at 4.6, you're looking at like a 6.5 rate, a 6.5 rate on the low end, to 7.5 7 rate on the high end. This is better than banks. 5 to 10 year, you get step down, which is good, which is not like CMBS. You can choose actually yield maintenance or step down, and the pricing adjusts. So you get better pricing with yield maintenance and a little bit worse pricing with step down. But step down prepay again is like a 5-4-3-2-1 or a 10-9-8-7-6 5-4-3-2-1, depending on the term of the loan. They'll go up to 80%. Standard is 80%, which is very high. I mean, you're not seeing that. The regular banks are generally not doing 80. So you get the max financing. It's a relatively quick close. You can close even quicker. You can close in 30 days, really. Process is non-recourse. Process is pretty simple as well. You're talking about no tax returns needed, right? They do not look at your financials. So that's a big plus. Banks generally do look at your tax returns and they do care about your overall strength. If you've got losses in another field, another business, another area, it's going to affect you. With agency, it will not. All right, that's all the good about agency. The tough part about agency is that you got to do reporting. Okay, quarterly reporting. You've got to constantly every 3 months send in a report for how the property is doing, your cash flow, your income, your expenses. And if you fall below a certain ratio, usually like it'll be a trigger ratio, like 1.1 DSCR, you'll fall into like special management, where you'll get an email from their management division saying, hey, you got to fix this. You have 30 days to fix this problem. If your vacancy falls below, even if your income is good, if your vacancy falls above a certain factor. So when you went into the loan, let's say you were at 5% vacancy and now you're at 10% for whatever reason, you have to actively manage your loan and your bank. It's that you can't just like close and go to sleep and pay your check. With balance sheet lenders, you basically close. As long as you pay, you will not hear from them. Here, they're constantly on top of the health of your property. So it can create, tension, issues. You've got to really have good oversight, good management. So that's kind of the one big downside here. And I've seen, properties where like, there was a flood or there was, electrical outage and they had a portion of the building or the entire building had to vacate due to code, right? You couldn't have a building with no electricity. So you have to vacate the building. On one end, you're getting killed because you got to put up everyone in, hotel. You got to foot the bill. On the other hand, your bank is going after you for, having a vacated building. So you got to be really on top of your game when it comes to management, and you got to deal with problems quickly and efficiently. Otherwise, they'll start foreclosure. So you got to, that's kind of the downside of it. Otherwise, it's all upside. The process is very much income-based, asset-based, and income-based. So they'll do an appraisal. They'll do a property condition report. They'll do a environmental, obviously, phase 1, if you needed phase 2. And the way that works is property condition report, they'll send a company down, they'll assess the remaining lifetime for all the major systems, right? So your roof, your HVAC, your heating, any other systems you may have, they'll look at the remaining life and they'll do holdbacks if it's shorter than the term of the loan. So for example, if your roof has a 3 years left on its life and you're taking a 10-year loan, they're going to build in either at closing or monthly an escrow to kind of hit, that amount that that is estimated to be needed. So if, let's say in 3 years you're going to need $150,000 for a new roof, they're going to divide that over the next 3 years, collect that every month, and then, but they're holding that escrow for you so that, in 3 years, you can actually go and draw down that money to pay for a new roof. So that's kind of how this works. You can do any size loan. I mean, you can go from $1 million to, 100 million. There might be a cap somewhere on the upper end. I don't know, but and they'll do portfolios. So as long as it's all residential, you can do a portfolio of properties. They can be non-contiguous as well. If they're all 2 units or above, they won't do non-contiguous single families, but they'll do non-contiguous 2+. So non-contiguous is you've got, all over a state, you've got, 100, 2 to 5 families. They'll do that. If it is contiguous, if it's in one row or attached or townhouses, they'll do even single family contiguous properties. That's kind of that. They're very much into it's all Excel work here, meaning getting the loan done is all, you submit, the properties, historicals, T12s, and they go through every single line item on the expense sheet, looking at your income, your expenses. Why did this move? You'll start getting questions from underwriters like, month over month, there was a 3% drop. Like, well, explain why taxes went down 2%. Like they literally dive into the smallest minute details of the cash flow to try to understand that this is actually a property that is producing income. So it's very, very much income and expense based. And that's pretty much it. You need to know for this. Again, we do agency.
So I'm curious, right? Like, let's just say someone brings you a 10 or 20 unit deal. What's your typical process for like which loan you try first and why?
Sorry, cut out there for a second. Can you repeat the question?
Sorry. Yeah, so I'm curious. So what if someone brought you like a multifamily deal, 10 plus units anywhere, right? In what order would you go about looking into what loan would be best for them? Do you start with agency? Do you start with
Okay.
DSCR? Just curious, like, where
Yeah, good question. Usually it's a matter of preference, right? So I'll fill out the person. Are they somebody who will have a professional management company with quarterly reporting, right? So the quarterly reporting is the biggest difference here. If it's eligible for both properties, you're asking, like, how do we know who to go? So we always try, agency is typically cheaper. So that's always the best option, except if you can't handle the quarterly reporting and kind of the holdbacks. So that would be the only reason why you wouldn't do that.
So you're saying agency is typically for a little bit more seasoned individuals who have management
Probably,
teams in place, and then balance sheet,
yes.
or bank loans are typically for the traditional everyday average individual who.
Yeah, I would say that. I would say that. Yes. Yes. If it's your first, property, first couple of properties, you'll want to go bank just because, they'll work with newer people. It'll be easier to deal with over the term of the loan. Generally worth paying a little bit more for that kind of relationship. If you're larger and you've got management or you've got like, or how to deal with issues well and efficiently, then you can, I would say go for agency.
So Ronnie's asking, how do the fees structure change depending on agency versus bank or CMBS or anything else?
So fees are generally lower on agency. The fee ranges between 0 points to 1 point. And that really depends on combination of pricing. There is like I mentioned earlier, there are these intermediary agencies that you have to go through to get to agency loan done. So they charge, various amounts. They make money on two places, on the spread and on the upfront fees. So this spread is built in, their fee is built into that. You can kind of negotiate down, you can pay points instead of, they're typically looking to make somewhere around 2 points. And they get that over, they get that on the spread every like 15 or 20 basis points gives them a point. So they'll, this kind of a trade-off, but the fees are not very high. The costs are the third parties. Those are the big costs relatively. I mean, you've got an appraisal, you've got environmental, and you've got a PCA. All of that together will cost you roughly $15,000. So that's kind of your upfront cost, and that's before you know if you're even approved. So you've got to be ready for costs. I mean, and truth is, you have those costs in banks as well. Not every bank will do a property condition report. It really depends on the bank. Agency will do it. But that's really it. I mean, the fees are typically lower. The big difference between your cost is the balance sheet banks want you to have assets with them, meaning they make you put down banking with them. You got to do deposits with them. So these days, they're making you put down between 10 and 20% of your loan amount and keep that average balance in their accounts liquid. They need liquidity, and they're forcing people. Agency does not need liquidity. It's not a bank. It's kind of just like a secondary market program where there's no deposits. These are non-depository institutions. Even if you are working through Chase, it's a completely separate department. They don't care if you open accounts. So you kind of end up with more cash at closing through agency, almost always. So it's really a good option for it's the first option for multifam. All right, it's really the first option for multifam.